Donald Trump recently raised its tariff on Chinese goods to 145%. In response, China increased its tariff on U.S. goods from 84% to 125% effective April 12th. China mocked the U.S. move, calling it a joke. China indicated that U.S. goods are no longer marketable in China under current tariff. If U.S. raises tariff further, China may stop responding with matching measures. China's response appears to be a concession. China suggests that U.S. goods are no longer marketable under current tariff level, but Chinese goods are still able to sell in U.S. despite 145% tariff. Some Chinese products remain economically viable due to its extremely low cost base. As an example, Chinese farming machineries like mini bulldozer, mini excavator, they cost around 25% of the US-made equivalents. So even with 145% tariff, those Chinese goods remain competitive in the US market. So when China claims it won't raise tariff further, regardless of the US action, China is hoping to signal a de-escalation in the trade war. The goal is to encourage US to halt further tariff increases because further increase can still hurt China further. It's aiming to protect Chinese industries that are still marketable in US. If today's US stock market has fully priced in a US-China decoupling scenario where two countries have zero trades, this development is a positive development because the market's worry for Chinese retaliation has passed. This is signaling a temporary end of the trade war. The market should stop expecting Chinese leader to visit US in person to negotiate anytime soon, because especially considering the embarrassment Ukraine faced after doing so. So in response, the US actually also softened its tariff on certain imports, but this policy softness is towards every country that was reciprocal tariffed. Trump's team announced that many items are not exempted from the reciprocal tariff, including many types of electronics such as smartphone, computers, and electronic components like memory chips, hard drives, and computer processors. Critical tools like ASML's chip-making machine was also exempt from the tariff, so that TSMC's fabs that are located in US are able to import them freely. And the administration recognized the need for precision in the tariff policies. Some supply chains are just way too complex and not feasible to bring back to US. And some supply chains or manufacturing are too low end to bring back. For example, the iPhone assembly lines, bringing them back to US will create a bunch of minimum wage job, which is kind of useless. And also for the extremely high-end manufacturing, to bring them back is impossible and feasible. For example, the ASML chip-making machine factory, that's just way too high-end. And besides, to add precision to the policy, the softening of the tariff policy is likely to aim to reduce the price shock for American consumers. Trump administration's tariff policy has triggered significant market turbulence. Higher tariff led to reduced U.S. import, worsening the trade flow. With fewer imports, there's less capital inflow into the U.S. due to trade imbalance correction. Less foreign capital means weaker demand for U.S. Treasury bond. And in theory, it's also happening to U.S. stock market. That's why we're seeing massive sell-offs. The bond price falling in the secondary market pushes the Treasury yields to go up. Anticipating this trend, investors began to sell Treasuries early, push yields to go up quickly. This weakens the US dollar, and at the same time, we're observing a strength in yen, euro, and Canadian dollar. This pushes up the price of gold to a record high level because gold are priced using US dollar. When US dollar weakens, gold appears to be cheaper for foreign investors, and at the same time, gold is considered a safe haven asset. during this turbulent time, it naturally attracts money. Minneapolis Fed President Kashkari discussed the underlying dynamics.
Why do we have a trade deficit in America for decades? It's because this is just the math of economics. Investors around the world have viewed America as the best place to invest. And if that's true, we will have a trade deficit. And so now one of the ways that expresses itself is in lower yields across asset classes in America. So if the trade deficit's going to go down, it could be that investors are saying, okay, America no longer is the most attractive place in the world to invest. And then you would expect to see bond yields go up. Now, it also could be inflation, and that's why this matters a lot to the Fed. I'm not seeing evidence yet that long-run inflation expectations are climbing, and it's the Fed's job to make sure that that doesn't happen. But I would expect to see, if investors decide, hey, we want to invest elsewhere, all else equal, that ought to be pushing up yields, and you'd see that in what we call the term premium.
But I think I can do a better job explaining the underlying dynamics. The U.S. trade deficit correction reduces global dollar supply. And with fewer dollar abroad, less dollar will be reinvested back into U.S. assets because less U.S. dollar is being recycled back into the economy, leading to a net capital outflow. The foreigners are not making as much US dollar as before. So they have less dollar to spend. That's the whole dynamic behind this. Amid this chain of events, the Federal Reserve is preparing for worst case scenario. Boston Fed President Collins stated, "We would absolutely be prepared to do what's needed." She said the Fed has tools to address potential market dysfunction and liquidity issues. She said emergency rate cuts are not the Fed's primary tool to address today's market deterioration. Collins has also given a clear signal that Fed is ready to act. But she didn't mention under what scenario would be considered a liquidity crisis. I think if bond yields spike beyond the historical highs, and which spikes the borrowing cost for US, this scenario would be considered a liquidity crisis. While the bond yields are elevated today, they have not yet reached a crisis level. The Federal Reserve has a range of liquidity tools, both small and large. For example, during the regional bank crisis when Silicon Valley Bank collapsed, the Fed used smaller liquidity tools. And if this turns out to be a bigger problem than that, the Fed could deploy the largest tool, which is quantitative easing, which is their money printing mechanism. So under today's current framework, U.S. Treasury bonds will never run out of buyers because if needed, the Federal Reserve will just step in and buy as a central bank. This reflects the unique privilege of having U.S. dollar as the world reserve currency. However, she emphasized that emergency rate cut will not be used as a primary response tool today due to high inflation. So if this scenario plays out, we could be seeing a very unique policy mix where the Fed keeps the short-term interest rate high while they pump money into the financial system to increase liquidity. And that would create a divergence in monetary policies. On the other hand, New York Fed President John Williams offered a recessionary outlook. He expects inflation could rise to 4% this year. U.S. GDP growth is projected to slow to below 1%. Unemployment rate would increase from today's 4.2% to 4.5 to 5% range. This reminds me of Sahm Rule. So the Sahm Rule says if there's a 0.5% rise in the 3-month moving average of unemployment rate compared to the lowest point in the past 12 months, that would indicate a recession. Sahm Rule was correct every time since 1960s, except in 2024, where it reached 0.57%, but no official recession followed. So this rule no longer have a 100% accuracy. So it looks like Federal Reserve now sees stagflation as a baseline scenario or expectation and are ready and prepared to implement liquidity measures to deal with the potential liquidity shock caused by the tariff policies under this stagflation backdrop. According to the latest reporting, University of Michigan Consumer Sentiment Index fell to 50.8. That's the lowest since June of 2022. Sentiment declined for the fourth straight month amid trade war concerns. And in the Michigan survey, there's also the one-year inflation expectation from the consumer's perspective, and that has surged to 6.7%, highest since 1980s. So despite a softening of CPI report, which we call the hard data, this consumer expectation we call a soft data is showing rising inflation fears. So consumers in America are increasingly worried and pessimistic. Poor consumer sentiment is problematic because according to BlackRock CEO Larry Fink, consumerism is the key to America's strength. He said America's greatness comes from being great consumers. American consumers seek the best quality at the lowest price globally. And because the consumerism is shifting due to Trump's tariff policy, he's now calling America a destabilizer of the world.
The United States post-World War II was a global stabilizer. We are the global destabilizer.
Right.
You know, that's a very hard thing to say because I pride ourselves of being, bringing the leadership, bringing the conversations. But I will say the power of U.S. capitalism is still alive. I will say more and more times clients worldwide are asking for our, at least at the CEO level, they're asking for our vision, our views. They still want to engage. They still want to build. So I'm less, long term, I'm less worried about some of these issues. But in the short run, I'm petrified at some of these issues. Another economic force, Jim, post World War II was consumerism. So we built the whole foundation of economic policy around consumerism, providing Americans with the cheapest products. Right. And so that was the foundation. Now, did that come at a cost that some of our communities were decimated where they lost jobs? Absolutely. So maybe we went too far on the whole concept of consumerism. But let's be clear, the major economic foundation was based on consumerism. And so we wanted our companies to go around the world to find the best places to provide the highest quality at the cheapest prices so we could consume more. We always thought that type of consumption was the most progressive form of economic behavior. More people could have more. And that was one of the fundamental reasons why the United States was the leader.
Yes.
Because our citizens were huge consumers.
So what he is saying is that U.S. benefits from the privilege of having world's reserve currency and its ability to print money. And U.S. can print dollars in exchange of foreign goods and services. It costs around 14 cents to print a 100 US dollar bill. But we're living in a digital world now. Even the 14 cents are not needed. Everything is digital. They just need a couple more keystrokes. They just type more zeros behind the number they're trying to print. So Larry Fink raised a very key and interesting question. If US can just print money and consume, why are we seeking a change now? This chart, I think, gives you a very good answer. It shows you what happened in the world from year 2000 to 2024. So in the year 2000, most countries are blue, which means that their main trading partner is USA. But in 2024, many countries shifted to red. That means their main trading partner has shifted to China. Okay, so as China's manufacturing capability is growing and their shift from low-end manufacturing towards mid to high-end manufacturing, global economic dependence on China has grown rapidly. This gives China a massive leverage on the world stage. If unaddressed, who knows how much longer the US consumerism can survive.